There's my picture. There's my contact information. So let's dive right into this. I'll tell you, you're going to get a kind of a master's course on how to grow your business and specifically how to use the EIDL from the SBA to do that. As I was putting this presentation together, I really was digging in, and I'm like, this is going to be good stuff. So strap on, strap in. Sorry. The first thing I'll say here is this pandemic and all of the federal money that came out of it provided a very unique opportunity for businesses. And obviously some businesses did not make it. But for those that did survive, it is a once in a lifetime, once in a generation opportunity to use this to take your business to the next level. So some basics about the EIDL that have changed from the beginning and just kind of an update. The applications are closed. They were closed at the end of December. So if you didn't get one, you're out of luck. However, if you did get one, you can still request an increase. And if you were denied or they did not process it completely, you can still appeal those decisions. The amount of the loan was raised up to $2 million. There, is a lot of nonsense on the SBA's website about how they go around underwriting it. What documentation you'll have to provide to get those increases. That's not been my experience with any of our clients or our own business. It's pretty much just drag the slider across and pick the amount. And there may be a few closing documents. The SBA website says that it requires personal guarantees on loans over 200,000. I have not seen those requests. I've not seen any guarantees required. One of the biggest changes that they made in the last legislation was they put in this provision that you can prepay commercial debt. There's no definition of prepay. The EIDL is designed to be a working capital loan with obviously a long-term repayment. So it was never intended to buy fixed assets or land or buildings. It was primarily to provide working capital. And you could always repay, make your loan payments with your EIDL loan proceeds. But this new provision that you can prepay commercial debt. What does prepay mean? I don't know. It doesn't say a limit. Does that mean you can pay the entire loan off? I'm going to say yes. I haven't until they tell us no, and there's nothing in the regulations that they have issued that shows that. I think it's a great tool to potentially clean up your balance sheet, and that's the next subject we'll go into. Also, federal business debt. Now, I'm not 100% sure what this means. If that means like if you have past due taxes with the IRS, payroll taxes, those kind of things. I believe that now is included as far as being able to use the proceeds. So with the idea of this is the framework that we're working with, what's the best strategies? What are the best strategies to use this money? I've talked to lots of clients and they're like, well, I got this money and it's just sitting there and I don't have to make any payments yet. I had a client that took all of the loan proceeds and invested it in a crypto finance interest-bearing account and was getting paid 9.5%. And so they're making 9.5% and paying 3%. I guess that's a great strategy, although that's not really what this topic is about. We're talking about how to use it in your business. But as long as you're making more than 4%, you're going to be ahead on these EIDLs. But I'd like to talk about how we can use it in your business and make you more money, hopefully a lot more than 3 or 4%. So first strategy I have developed is to clean up your balance sheet. Now, What does that mean? That means that most businesses have some loans. They might have, through the pandemic, run up a bunch of trade accounts payable, any debt that the business owns. That's what I'm talking about on the balance sheet. So because we can now use the EIDL to prepay or pay off, however you want to word that, commercial debt, it's time to start looking at your balance sheet and your existing loans and say, okay, what do I have that is an interest rate or a term that is less favorable than the EIDL? And the answer is all of them. There is no long-term money at 3%. That doesn't exist out there. So pretty much any loan you have is going to be better for your interest cost and your cash flow to use the EIDL loan proceeds to pay off that existing loan. Now, here's a caveat. Obviously, if you take 20 years to repay a truck loan that you had for 5 years, you're going to pay more interest, but that's not what we're contemplating here. What we're contemplating here is getting rid of high interest debt that doesn't with a lower cost interest. If you don't pay it back in the same amount of time, obviously your interest cost is going to be higher. So I'm not suggesting you take that truck loan and pay it off over 20 years. That's not what I'm suggesting. But looking at the interest rate and terms by loan and prepaying them and freeing up that cash flow and that interest. Second item is your accounts payable. A lot of vendors will offer terms, net 10, net 15, where you're going to get a discount by prepaying that invoice. So if it's normally due in 30 days and you pay it in 5, you're going to get a 10% discount. Well, if you add that up, that's huge over the course of a year. So really looking next at your accounts payable, are there any ones that are charging you late fees, or is there any that will offer you discounts that would add to the bottom line? Now, if they don't offer it up front, like that's not their standard, you can ask. I mean, just ask for better terms and use that EIDL money to prepay your payables and get your materials and those things at a discount. The last thing is cash reserves. Every business should have 2 months of fixed costs. Now, I'm not talking about like if you're in a business where you have materials and those kind of things that you're buying. I'm not talking about your cost of goods sold per se. I'm talking about your fixed expenses. Having 2 months in reserve is kind of interesting when you go back and you look at the PPP loans, and how they calculated it. Well, it was 2.5 months worth of payroll. And there's a reason behind that. And because that is a good buffer. It is a good cushion to have. Think back about pre-pandemic. If you'd gone into the pandemic and had been sitting on 2 months worth of cash, what would you have been able to do with that PPP free money, tax-free money that, well, you know what? They're giving it to me. I don't need it because I got the cash, but hey, it's free money. So, getting that cash reserve set aside of 2 months is a benchmark you should strive for. So looking at the clean up the balance sheet strategy, it's get rid of high cost debt, get better terms from your vendors, and build up your cash reserves so that you don't need to go broke whenever the next pandemic happens. I didn't mention at the beginning, but if you have questions, please feel free to pop them into the chat. Or the raise your hand, however you want to do it. I'll be happy to answer those questions. All right, so now let's go on to the second strategy. If I can figure out my damn computer. Stand by. Nope, that ain't it. There we are. Strategy 2, and this is where the bulk of the material is going to be today, is grow profitably. So you've cleaned up your balance sheet. You got 2 months cash reserve. All right, now what? I've still got a couple $100,000. I got $100,000. I got $50,000. I got money in the bank. I don't know what to do with it. I don't have to repay it yet. Should I just wait and repay it when the SBA starts asking for payments? Well, that's always an option, but I'm going to propose to you that there is a better option, and use that capital to grow your business. So the first thing I look at, and in every business I consult with, is what is your labor efficiency? And we're going to go through a couple of examples here in a minute, but very simply, the labor efficiency is your gross profit divided by your labor cost. And it depends a little bit on the size of your business and the industry that you're in. But a good rule of thumb is 2.5. So if you think about it this way, if you've got $250,000 in gross profit, not sales, gross profit, then your labor costs all in, payroll, taxes, benefits, should be 100,000. That should be your benchmark. And the very first thing to do with that capital is to grow your business to where you're, without adding bodies, so that your labor efficiency is in that 2.5 range. If it's below 2, you're probably in trouble. If it's above 3, you're probably in some type of capital intensive business. But the point is that if you think about your business, yeah, you can market, you can deal with vendors, but the most leverage you have in your business is getting more out of your people. That is the number one thing that you can control in your business. And that's any business, because I haven't found a business that doesn't involve people. So maximizing that labor efficiency. If you are not sure what your labor efficiency benchmark should be, drop me a line. I'd be happy to look it up, compare you to the industry, and help you figure that out. The second aspect of this strategy is a term that Greg Crabtree, author of Simple Numbers and Simple Numbers 2.0, highly recommend those books. He calls it the cash power ratio. And basically the cash power ratio is your ability to grow your business with the working capital that you have. This is not the cost of acquiring. It's not the marketing. It's what does adding a new customer do to your cash flow, just the way your business is structured. So we're going to go through an example on that. So then the third thing is looking at, well, okay, so I've maximized my labor efficiency and I've looked at my cash power ratio and I know that I can grow without having to go get more capital. Then I have to figure out how to go get them. I'm not a marketing person. I rely heavily on those that specialize in that. But the two things that I do know as an accountant that I need to know are, what are the costs of acquisition to bring in a new customer versus the lifetime value of a customer. So lifetime value of a customer is a very simple concept. It's you take a new customer. I don't care what business you're in, whether you sell service or widgets, it doesn't matter. You have a natural lifetime of that customer. You have a natural number of transactions. You have a natural average spend. And you can do this at the highest level of your company. Just, you don't need to get into the granular and figure it out by subsets of customers. Just start with, what is a customer worth to me when I bring it in? Okay. If if we're talking about core as an example, our average client pays us somewhere around $6,000 a year. We got some that pay less, some that pay more, but our retention is 90%, which means they're with us 10 years. And so that means that lifetime value of a customer is $50,000, $60,000. And that's a huge number, right? Especially when you start saying, well, what does it cost to bring them in? Now, in our industry, it is very expensive to bring in a new client. And you can imagine why, but in your industry, in your business, you can just take the amount of marketing dollars you spent last year and how many new customers did you get, and that gives you your average, and that's good enough for what we're trying to do here. The whole point of this calculation is to see what can I spend versus what it's worth. If you're thinking about this, is that if it costs me $5,000 to go buy a $50,000 business or asset or revenue stream investment, if you will, that's pretty much a no-brainer, right? I mean, you do that all day long as you had enough capital. But the cash power ratio and the cost of acquisition versus lifetime play into each other because they both impact the cash flow. You could have a very low cost of acquisition and a very low lifetime value of customer. It doesn't really matter. It's just the relation of that ratio between the two. And then the last component of this strategy is a target net income. So we start with labor efficiency because that has the biggest impact. But then when you figure out all the other controllable expenses, rent, insurance, utilities, those kind of things, having a target net income is critical. And I'm going to tell you that most business owners and most entrepreneurs don't make enough money. There's a lot of reasons. There's a lot of stories we tell ourselves about why we didn't make money. But I'm going to tell you that as a one owner business, if you take what you make from the business plus whatever you take out in salary, it needs to be 25%. If you're a solopreneur and you're, don't have any employees or maybe some independent contractors, it needs to be 50% or 60%. But your average business, I think a 25% is a good target. So let's look at this labor efficiency example, and I've got a misspelled slide, so yay for me. So business has 1 million in revenue. Cost of goods sold is 500,000. Now, what is cost of goods sold? Cost of goods sold is all of the direct costs to deliver that revenue, okay, except labor. So if you're in the service business like we are, our cost of goods sold is primarily software. So we have to spend a lot of money on real expensive software to do what we do. But it's just if you build houses, it's sticks and bricks. It's not it would also include any flow throughs to subcontractors. But basically what you're looking at there is everything that is a direct cost of delivering that service or good, except labor, is your cost of goods sold. So in this example, we have 1 million revenue, cost of goods sold is 500,000. That leaves us gross profit of 500,000. And if our labor is 200,000, including payroll taxes and benefits, our labor efficiency is 2.5. Solid. Let's look at the cash power ratio. I didn't put a graph in here and I should have, but the cash power ratio is essentially looking at the percentage of your trade capital as revenue and comparing it to your gross margin. Now, your gross margin is simply the percentage of your gross profit. So gross profit is a dollar amount, gross margin is a percentage. So in this situation, the gross margin is 50%. Okay, so same concept, just percentage versus dollars. So the cash power ratio is comparing that percentage of trade capital of revenue versus gross margin, which is also of revenue. If the gross margin is higher, that means you have free cash flow and you can grow setting aside cost of acquisition without additional capital. If not, you need capital, such as the EIDL. So in our case, the gross margin is higher than our trade capital, so we can grow cash free. But then when you start adding in the cost of acquiring the client through marketing efforts, you do need additional capital. So it would depend upon your business, but starting with cash power ratio is the first step. And I'll give you an example of what that would look like. So this business, they have inventory. I know a lot of businesses don't anymore, but if you looked at their balance sheet at the end of the year, we pull out December's numbers. They have 100,000 in accounts receivable. They have $75,000 in inventory. They owe their vendors $50,000, and their annual revenue is $600,000. So using that annual revenue as our denominator, we're looking at accounts receivable is 17% roughly. Inventory is another 12.5%. That's 100,000 divided by 600,000 is 17%. Accounts payable is a negative because that means that we get to delay the cash out. All right. So it's written as a negative, but it's still 50,000 divided by 600,000. And we just total those columns to 21%. That's what their trade capital as a percentage of revenue is. Let's assume that their gross margin is 50%. Well, they can grow all day long. The working capital need of the company, financing the receivables, buying the inventory, less the time it takes our vendors, pay our vendors, you can grow freely. That again doesn't count the marketing costs, but it does determine whether you need money just to grow. Some businesses that are heavy into inventory or they extend credit, like I can think of some clients of ours in the oil and gas space where, if you get paid in 120 days, you're doing good. Well, it doesn't take you long to grow into bankruptcy there if it takes you 6 months to collect your receivables. So that's really what this calculation is about, is if I grow, if I add customers and revenue, what does that do to my cash flow on my balance sheet? And that's a quick, simple way to do it. So I have talked real fast. I would love to have some questions if we have any before we adjourn. Any questions? All right, I'm going to go back to my email address so you guys can have that. And you can ping me anytime you want at cbrim@coregroupus.com. My phone number is area code 405-210-0354. Shoot me a text, give me a call. I'd love to answer your questions, help you with any of these calculations or any strategies on how to use that EIDL money. Thanks a lot. Hope you guys have a great day.